Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. I'm this guy right over here, so you can kind of put a name to the face. Today, I want to discuss with you. I have my little digital notepad out. I want to discuss with you the basics of whole life insurance and just some things that I think you guys will find pretty favorable, and whether or not you should use it for your either retirement situation or life insurance situation. And I just kind of want to unveil some of the pros and cons of each. And I really hope that this video helps you guys out. First off, I want to conceptualize how a permanent life insurance policy works. And then discuss the pros and cons of a whole life insurance policy in particular. So first we're going to start off, and what happens is when you first purchase a life insurance policy, that's money, and I completely apologize for my horrible handwriting. I know that there's going to be a bunch of comments on this video of how freaking horrible my handwriting is, but just bear with me. You pay your premium dollars into a life insurance policy. And what happens is this money goes into two separate segments. One known as the COI, the cost of insurance, and another known as your cash value. Now, I just want to talk about the cost of insurance because I think that's pretty important in the beginning. Your cost of insurance is basically your insurance expenses. So it's your expenses, your fees, etc. So these are basically your insurance expenses. This portion, it always needs to be paid because this is what keeps your policy in force. It's your death benefit. This is life insurance. So life insurance has a death benefit, and it's a tax-free death benefit at that. But you always have to make sure that this cost of insurance is paid to make sure that your policy stays in force. Now, a lot of people and advisors, especially advisors, which I'm really surprised about, they do not know this, but all permanent life insurance has a built-in one-year term that increases every single year. So that's one of the factors that determine the cost of insurance. There's a lot of little intricate details that determine the cost of insurance, but I just want to make this as simplistic as possible. And I'm going to show you an example a little bit later on to kind of show you why that is a little bit important of the one-year term that resets every year depending upon what your age is. So when you start a permanent life insurance policy, majority of the fees and the expenses are paid within the first 10 years. Okay? So you have the 10 years are usually where you have the heaviest amount of fees, which is going to lead me into the cash value side, because I don't want to get too involved into the cost of insurance yet. I want to kind of talk about the pros and cons of each. So I just want to kind of go over the cash value side. Your premium dollars go into the cost of insurance and the cash value. I want you to think of this cash value as kind of like a savings account. After the cost of insurance is paid, the remaining amount is then placed into the cash value. Now, what makes the cash value more attractive with some companies than others is the percentage rate that is paid every year on your cash value side. Remember, cash value is just like a savings account. I apologize for the horrible handwriting. So the money that is being placed inside of the cash value and the percentage rate it gains year by year increases your cash value. Now, there are many pros on permanent life insurance, and a lot of them has to do with that actual cash value. So I'm going to go over the pros. Essentially, you could leverage this cash value account in different ways. And these are just the pros. So, I'm going to reveal everything to you. And, some advisors might be upset with it. I don't really care. This is meant for the, for the individual, this video. The first thing is money grows inside of a cash account tax favorable. Meaning that the amount of money that you're placing in there and the percentage rate that's gaining every year is not going to be taxed every time that you have a gain, like some other investments out there. So you're not going to, so it's going to be very tax favorable inside of that actual cash value account. So we'll say tax favorable. The second thing is that you could pull this money out tax free. I know a lot of people are thinking, wow, that's actually pretty good. And this is what a lot of the hype is about on cash value life insurance policies. You have to be extremely, extremely careful when pulling money out of your cash value and doing it in a tax-free manner. You have to deal with an advisor that knows what they're doing, because this could be a huge, huge mistake, and this is what majority of people do. And I'm not trying to make this a sales pitch at all, but leverage our company. We offer 24/7 customer service on our life. We have an entire division separated for life insurance. And if you have an existing cash value policy, give us a call. Or if you're interested in whole life insurance or other types of cash value life insurance, give us a call, because we can explain to you exactly how those work. And some companies are more favorable than others. But the major thing is you do not want to make that mistake and pull money from your cash value thinking, oh no, my advisor told me it was tax-free. You have to do it in a certain form. It comes out in like the form of loans, but you have to really deal with an advisor that knows what they're doing in order for that to be favorable for your situation. The very last thing is, or at least one of the last pros about cash value, is there is no 59.5 rule on this money. So that means that you could pull out this cash value from your account anytime before age 59.5. And for some people that are not familiarized with it, whenever you have like a 401k account or an IRA account, you cannot touch this money before age 59.5, or else the IRS is going to penalize you on that. So this is very, very important. Like, let's say if you want to retire at age 50 or 45, and you have certain pension income coming to you, and you need to supplement that retirement income, you could actually pull money out of a cash value life insurance policy to supplement that retirement. And the good thing is it comes out tax-free when done correctly. And one of the other last things is you also have a tax-free death benefit. So this is life insurance. The good thing about life insurance is you're leveraging the law of large numbers, and you're leveraging the life insurance company, so you're paying small premium dollars, and other thousands of millions of people are paying small premium dollars to basically bunch all this money up in the hole as a whole, and these large older life insurance carriers basically pay money to you, and they leverage mortality rates and mortality tables, and they pay tax-free death benefits to beneficiaries, which is also very important, because your 401k, your IRA accounts, those are fully taxable to your beneficiaries. It could be income in respect to the decedent. You have different, tax flaws, things that will kind of work against you regarding taxation whenever you actually inherit those sort of accounts. So right now I kind of discussed with you the pros of cash value, but now I want to actually show you how a whole life insurance policy works. I was kind of generalizing a lot of the concepts of just cash value policies. So what are the pros and cons? Well, you have money that goes into this life insurance. And I'm going to repeat myself, but there's a reason why. I want to make sure that these concepts and these little strategies and this information instilled into your brain as much as possible, so that you could obviously replay and stuff like that. But I want to make sure that you guys are really understanding the most important aspects. So if I repeat myself, just please bear with me on that. Your money goes in. You have cost of insurance. Money goes into the cost of insurance, and then also the cash value, which is like that savings account. Now, we understand that the cash value increases with premiums paid, and the percentage growth. This cash value percentage growth in a whole life insurance policy is computed off of something known as a dividend rate. So you have different cash value policies out there. You have like a VUL, which that cash value percentage rate is computed off of mutual funds. You have a UL where it's off of interest rates. You have an IUL, which is through like an index. But the one in particular on whole life insurance is computed off of a dividend rate. So the larger, typically older life insurance carriers pay good dividend rates because they understand, and a dividend rate it's a return of premium to their policyholders. And I don't want to confuse you on that, but these larger companies, when they could understand the mortality rates, meaning like the chance of somebody who's 55 dying or the chance of somebody who's 80 dying, the better that a company could understand those mortality tables and the amount of money in their general accounts, they can offer you favorable dividend rates at high percentage rates. And that's what's very, very important. So you don't want to go with a fly-by-night company. You want to go with an actual, top-rated insurance carrier to make sure that that dividend is very good. And is paying you a decent rate. But one thing you have to realize is it's not sexy. Life insurance is not sexy at all, but it is consistent. And that's why people purchase that. I mentioned previously that your first 10 to 12 years, that's where majority of your actual expenses, your cost of insurance is the highest. And it takes about, and this kind of correlates, it takes about 10 to 12, sometimes 10 to 15 years, depending upon what the company is. It takes about 10 to 12 years for your cash value to actually equal the premium dollars that you placed into this policy. And that's due to the cost of insurance. The first 10 to 12 years, that's going towards different sorts of fees. It's going towards admin fees. It's going towards insurance commissions. It's going towards the the policyholders of their previously owned policyholders, because this is the law of large numbers. Now, every year, the cost of insurance is going to be slowly increasing due to 1 year term. 1 year term, it's called annual renewable term life insurance. And that is what's built into the cost of insurance. So, if you purchase your policy in your age 30, your 1 year term to sustain the death benefit is going to be a heck of a lot cheaper than when you're 70 years old. I mean, it could be, something from $100 a year at age 30 to something that's, $10,000 a year at age, 75. It's a huge, huge difference. The major thing that happens with these life insurance carriers and kind of what makes some companies better than others is if your cash value, basically the premiums paid and the percentage rate that it's increasing by are compounding quickly, because that's basically tax favorable growth. It's the power of compound interest that is compounding within that cash value policy. If those are compounding quickly, you can have a large cash value asset. And I'm going to stress this word asset because this is where a lot of things are flawed, and you see a lot of the Dave Ramsey, the Susie Orman. This is such a big word because an asset is not an investment. It's two completely different things. You are gaining an asset whenever you purchase a whole life insurance policy. Can you leverage, your cash value to supplement retirement income? Of course you can. But you need to understand what you are doing, and you need to understand the cons correctly, because all I kept talking about was the pros about this cash value. You really have to understand the cons and what exactly, whether or not this is, suited for your particular situation. The number one con, and I'll keep this very, very basic. If you are too old, and, or, I can even mention the word or in there, unhealthy, I do not recommend a cash value life insurance policy. I do not recommend a whole life insurance policy, because cash value can be used to basically leverage and to take at a later date in time. But if your cash value is becoming dwindled away because of the cost of insurance, then you're never going to ever, you're never going to touch this cash value, regardless of what the advisor is going to tell you. Oh, you could touch this cash value. No, because you need to have cash value in there. You don't want to be messing with the cash value if your cost of insurance is going to be too high. Now, what makes the cost of insurance go up? Age, definitely, and then also if you're unhealthy. So if someone's like 70 years old and you have a rep that comes to you, say, oh, well, you want to grow this thing because of your cash value. No. Cash value and whole life insurance policies are best used long term. It's a long-term asset. So you're owning these types of policies. You don't want too much to go into the cost of insurance, because if you're looking for, if you say, well, Derek, I'm looking for something to have a maximum death benefit, and I understand that, whole life is going to be paid out, their death benefit is going to be paid out 100% of the time as long as they don't mess with the cash value, I want to go with that. There are much better options to maximize the death benefit. Okay, there's much better different options out there. I have a video out there. It's called Guaranteed Universal Life, and a lot of representatives actually do not know about this. But if you're not looking for cash value growth within a policy and you're looking primarily for death benefit purposes, this is a much cheaper alternative for majority of the companies out there. I'm going to, kind of throw that little disclaimer in there for majority of the companies out there. But that's something that I really want you guys to do, is leverage my company. It's retiresharp.com. Right up here, and I have an entire section designated for the life insurance. Once again, my name is Derek Afasi. We're open 24 hours a day, 7 days a week, to make sure that you have that peace of mind. We have an entire life insurance division. So if you're basically, calling up and you say, okay, I want to either leverage or, told me about to basically utilize certain, certain life insurance carriers, or whole life insurance is some great investment. No. First off, whole life insurance is a good asset to have. It's a good thing to have in your portfolio because it's consistent. But you have to also understand that if you're a certain age, if you have certain ailments, some companies are going to be more favorable than others. We actually represent over 200 different life insurance carriers with our company, and we work, we basically educate all throughout the United States. So at least give us a call. Leverage our company for education first. If you have existing policies, if you're looking for new policies, just leverage leverage us as a resource. I mean, we don't charge anything for it, and just try to become as educated as possible, and that's what you're going to do, whenever you call up our company. I'm going to have a link directly to our life insurance division and to our whole life insurance division on our website, underneath this video. But please leave your comments. Please leave any questions that you have. And once again, I apologize for my sloppy handwriting. But my name is Derek Afasi. I'm that good-looking guy right over there. And I want to thank you very much for your time. I really hope that this video has helped. And please be on the lookout for some of my other videos. Thank you.